Our perception of money is changing rapidly, and banks are at the center of all of it. From how we access it, to how we buy, to how we trust that that money will be there when we need it. I'm Kiah Haslett, the creator of FinTech Takes Banking. Here on Bank Nerd Corner, I talk with bankers, economists, academics, and more about the complex dynamics shaping the financial services landscape. This week on Bank Nerd Corner, I'm joined by Dan McGonegle, a senior manager at Crowe. Before that, he was the manager of the Novel Activities Supervision Program at the Federal Reserve Board and has experience as a bank examiner. We chatted ahead of Money 2020 and how Dan's new role at Crowe means he'll need to be less of a wallflower than in years past. We then delve into the rising interest in bank charters from new entrants, including companies in the crypto and stablecoin space, what regulators want to see from these applicants, and how bank regulation might be shifting from narrow supervision to a broader policy lens. Banks worldwide use Tactile's AI decision platform to power their credit, fraud, and compliance workflows and adapt them in weeks, not months. Built for banking, Tactile's platform is transparent, audit-ready, and made to test and optimize decisions continuously. Learn more at tactile.com. Hi, Dan. Thanks so much for joining me.
Hey, Kiah. It's really great to be here.
Well, I am so excited to chat with you. When I told some people that I was going to be launching a podcast and was casting about for interesting people to speak to, your name came up more than once. And so I am so glad we were able to connect. Can you tell me a little bit about yourself and your career?
Yeah, well, first of all, I'm flattered and really happy to kind of join the conversation here and share some of my perspective. But yeah, so I'll try to give you the short version because it can get a little long sometimes. But it really kind of starts with me being at Crowe, where I sit in our regulatory compliance and financial crimes consulting practice. I really focus on two things, stablecoin and digital asset activities for financial institutions, and what we kind of call bank and fintech partnerships or banking as a service. And
sure.
I guess the reason I focus on those two things is that that's really kind of where the depth of my experience comes from on the regulatory side. And so I was with the Federal Reserve for almost 18 years before joining Crowe of earlier this year. And it was really kind of a long and winding road, but had a number of tremendous opportunities with the Federal Reserve System that started with being a community bank examiner in rural Iowa, really kind of traveling from small bank to small bank, understanding how they work, how they meet regulatory and supervisory expectations, and really how they kind of just serve their communities.
Yeah.
From there, I went to focus on capital markets risk, spent some time doing IT and cybersecurity work. And that's really where I kind of fell in love with fintech and started noticing this thing called banking as a service. And that's something that really kind of took me to the Board of Governors in DC, where I spent the last 5 years of my time, focused both on supervision and policy work, ranging from community bank issues to banking as a service, the digital asset activities, and really kind of culminating with the development of what we called the Novel Activities Supervision Program. And so, believe it or not, like that's the really short version.
Yeah.
But all a lot of like really fun and interesting stuff from different angles, and really, really excited to be on the private side and bring some of that perspective for the greater benefit of our financial institution clients.
That's great that you kind of saw the nascent banking as a service business line, like being born and growing up, and then to kind of see it change over time. I feel like I had an experience like that in 2014 and 2016 when one of the original banks received like a consent order, and I felt like I really learned about, like, it really peeled back the model when you had to look at that consent order. I'm sure we're both speaking about the same thing, about the same one, but and then to see it on your end as a bank examiner being like, wait, prepaid cards? Wait, what?
Yeah, it was really a wild evolution. I remember like my curiosity really peaked in like around the 2017 or 2018 timeframe. And
that's good stuff.
I'd see these commercials on TV and they'd be like advertising FDIC deposit insurance. And I was like, well, wait a second, like they're not a bank. And so like, how does that work? And so like, this is perhaps like the most nerdy bank examiner admission I can make, but I would like scroll to the fine print at the bottom of the website and figure out who they were banking with and then go into our systems and read the reports and exam for those banks. And, it was really interesting because even back in 2017 and 2018, I think once you started laying out some of these different institutions next to one another, you saw a lot of commonalities in that, like, third party risk was an area that was different than most community banks. The area of BSA AML was different, and really started to think about the construct of these relationships and how that impacted the risk implications, and really just the operations of these relatively smaller financial institutions. And it was really just kind of that curiosity that like carried forward throughout my career for like the next 7 years, and honestly still going. So
yeah, that life-changing TV commercial, that's the kind of impact you want some of your marketing to be having. So did you have aspirations when you were growing up or in college to become a bank examiner? Or how did that happen?
Well, I said, like, I already like made my one nerdy bank.
Yeah, you've already used one of them.
This one might be worse. No, I actually, like, I knew I wanted to be a bank examiner. And
what? No one wants to be a bank examiner. What?
I've worked with so many friends throughout the years that like started this job, and they said, like, well, I didn't even know what it was, and I didn't learn until like a year into the job. But I mean, the real short version is that I was really lucky and had some great mentors in college. And took a bank management class, and we had the opportunity to attend a really prestigious conference put on by the Chicago Fed. Ben Bernanke was like the keynote. This was 2006, and the whole theme of the conference was commercial real estate and whether or not there was a bubble or not. And so you can imagine like how interesting that was before that bubble had burst, and really just kind of opened my eyes to all of the different perspectives, what risk management is all about. And so, when I had that experience and had a couple of internships that I wasn't crazy about, when I heard about the idea of being a bank examiner, I'm like, that's it. That's what I want to do. And so really started with the Chicago Fed in 2008 as a community bank examiner. And, I kind of gave you the
Iowa
whole spiel already. But yeah, I mean, I think the idea of focusing on risk management, understanding both the financials and the people aspect of what regulators do was always attractive, and something that I really knew from a pretty young age that was something I wanted to do.
It's funny. Bankers have It's a Wonderful Life, and journalists have like All the President's Men and Spotlight. Like we all have these movies made about us, but like, did you feel like The Big Short or some of those, like Margin Call is like the movie that like is about bank examination, like, this is going to recruit the next generation?
I mean, like, I was just having this conversation with my wife, and we were listing like our top favorite movies, like 5 top movies, and The Big Short was definitely on my list. Like, having lived through that, as a bank examiner, I have a new appreciation, and I thought they nailed some things. And so, yeah. And then you mentioned It's a Wonderful Life. I think that's the only movie where a bank examiner is portrayed, and it's
right.
He might have like a minute and a half of screen time, but that
he's not very good either.
No. But that one definitely, that one kind of sets the tone for the way people view bank examiners, I think. Sure.
Okay, so before we move on, both you and I are going to Money 2020, which when we're recording this hasn't happened yet, and when it comes out, it will have happened. What are you looking forward to? What are you like kind of nervous about, if anything? And then what shoes are you bringing? Because I've heard the number one thing is shoes.
Yeah, these are the 3 best questions about Money 2020. Yeah, I think... So I attended for the first time in 2019, and I haven't been back since.
Okay.
And so that's obviously some time. A lot of things have changed. And I think the first thing I noticed when I attended Money 2020 is that the conversations between the bankers in the room and the fintechs in the room, there was a really big gap in terms of the language they were using, the ideas that they were expressing. And so I think I'm really excited to see whether or not that gap has closed in a meaningful way. I think back then the conversation was around disrupting traditional finance. And I think that's kind of given way to this idea of partnership. Maybe we're moving back towards that disruption phase and, where we're at in the innovation cycle. So really excited to kind of see those themes kind of come alive in the conference. What I'm nervous about is that the first time I attended, I was a regulator. I got the opportunity to just be a fly on the wall, like a wallflower, just observe. And now I have some responsibility as a consultant.
Oh
And so like exercising my extrovert skills is not my strong suit. So maybe I'm a little nervous about that, but I know once I get there and we start having conversations, I'm going to enjoy it. And then as far as shoes go, I'm in the comfortable dad tennis shoes or sneakers phase of my life. So if you see there and like see me in my Hokas, like please don't judge.
Are they? I was going to say, are they white? Are they white shoes?
They're like gray. They got a little blue on them, so it's not like it could be worse. But I feel like I'm definitely in that transition phase, and it's that might be where I'm at. But I'll try to pack some fashionable sneakers as well.
This is like so not related to banking at all, but one of the things about moving from maybe more of the being more bank facing and doing certain types of events that were mostly attended by bankers, I have a very specific conference wardrobe, and and it's business. It's like business formal, and like blazers and the slacks. And I am having so many issues with wardrobe trying to go to these conferences that are more casual than that. And I'm like, and the shoes and the jeans and like a novelty blazer, like girls love a novelty blazer. And it's like, it's not the most important thing at all, but it is a thing I'm encountering a lot. And I'm definitely having that problem with Money 2020 and all the walking. Like I need like something I can put 20,000 steps in, like an outfit that's appropriate for a variety of people and 20,000 steps.
It's a very small target that we have to hit.
Okay. So, Dan, I wanted to talk to you because I think you know a ton about banking. You've seen the industry change over time. You've been on both sides, the examination, the regulatory side, and now kind of working with banks and different companies to really think about the future of the financial services industry, the future of money, the future of banking. So my first question for you, my real first question, is that it seems like everyone wants to be a bank right now. Why does everyone want to be a bank right now? Why is that?
I mean, I think this is a great question, and you're right. Like it's like every other day we read about new charter ideas.
It's like crazy after like a decade plus of nothing.
Yeah, and now it's like, and I mean, I think we know why, right? Like policymakers have signaled their openness to this, and they're certainly backing that up through the early days of this new administration, and so. The tone has definitely changed and the door is open. And so, I think it's a great thing that we have more interest in bank charters. I think as far as like what's driving that, there are a couple of thoughts that come to mind. I think the first is this idea that payments can be better, right? And I think if you dive into the way that payments work within the US today, like you'd be surprised at how complicated and messy and cumbersome it can really be. And so I think everyone has an idea on how to improve upon the payment system. And if you're going to do that, then you really have to have access to the base layer or that infrastructure layer that's operated by the Federal Reserve, right? And so the charters provide that access, in most instances. Maybe we'll talk about that. But I think that's probably like the biggest case, right? In that, access to the payment system, if you're going to do it efficiently, effectively, and without reliance upon another financial institution, then you really have to be an entity that has access to master accounts with the Federal Reserve. I think that's really interesting in that. In the context of digital assets, we've long been kind of talking about this idea of interoperability. And I think about interoperability as meaning kind of that really the play between digital assets and fiat currencies. Okay. And I think banks kind of really sit at the nexus of that. And so, I think it's interesting that you have these entities that are really bought into this idea of digital assets and it being kind of a self-contained ecosystem, yet they're still seeking charters to become financial institutions. They're still seeking access to the payment system. And I think that's really kind of an indication that interoperability is going to be a thing for a long, long time. Yeah. I think we've kind of come out and said that, we're not really interested in having a CBDC within the US. And until we do have a CBDC, there's going to be at least some degree of interoperability between fiat and digital assets. And I think everyone's recognizing that that's going to be the case. And a bank charter is a really good place to be, to kind of sit at that nexus and facilitate that future of improved payments. The other big thing I think about with this dynamic here is you you hear it all over the place, but I kind of think about it as like the Uncle Ben principle, right?
Okay.
Of like from Spider-Man, that, where he says like great power comes with great responsibility. And I think about that all the time in the context of a bank charter, and that when you have the ability to leverage deposit insurance, the payment system, extend credit, that's a really powerful combination of services. And some of that relies upon public utilities like deposit insurance and the payments access. And so when that's the case, then there needs to be that responsibility piece. And so thinking about ways in which those institutions access those public utilities in a very responsible manner is something that sticks out to me as a former regulator.
Yeah, I've had trouble sometimes articulating this fully, especially like when I talk to some bankers that maybe don't share it. But increasingly, I think about the bank charter as a piece of technology, and not just like a license, and it's not like a thing that allows you to exist, but which it is those things as well. But the kind of things it allows you to do, the combination of such, and I think that thinking about charters that way, one, helps us understand why these non-banks are interested in them. And then two, helps banks understand their competitive advantage. And also, like, if you want to be a company that has a bank charter, certain things in the future may be expected of you. And we would want to see maybe investment and in those areas that better reflect where money is going, or how people understand money, right? Or use it. So, I think when we say charters and like charter applications, everyone kind of has an idea of what charter they're thinking of. But something I've been really amazed by, in addition to just the sheer like 0 applications a year to like, I don't know, 20, is also like the type of charters that different companies are interested in for different reasons. And so, and I include applications to buy a bank as part of these charter applications. But we also have like ILCs, National Trust Charter, and then like a full national bank charter. So can you talk a little bit about the different types of charters, especially, thinking about from the regulatory perspective? Why do we have so many? And then also we kind of feel like we don't have enough, because there's a concern that some of these companies are kind of like, transforming the historic uses of these charters.
Yeah, I mean, it is a pretty diverse mix. And like you said, Kiah, like maybe we don't have enough, right? I think like at a broad level, having that diverse mix of charter types certainly helps like financial institutions meet the bespoke needs of their customers, right? And so I always think about like, how does this support financial inclusion? Like, how does an ILC compare to a commercial bank or traditional commercial bank? And in what ways do those two charter types allow for different business models to thrive and succeed? One of the first things I did when I kind of moved from an examiner role to a policy role was focused on this idea of like paths to banking, right? And that, an entity might take a variety of paths to kind of get to that ultimate destination. And one thing I even included within the list was bank and fintech partnerships, and that we've seen some entities that have kind of started out as like a fintech that's relying upon a banking as a service model, and then they've kind of crossed that gap into becoming a financial institution. And I think about whether or not that helps those financial services kind of reach some of those darker corners within our system. And then also whether or not this diverse set of financial institutions really helps to drive innovation in the financial system as a whole, right? And so I think certainly that choice can be a really good thing. And having this variety of options to pursue can allow for a broader set of business models to kind of succeed. And that ultimately leads to greater financial inclusion. I think the big thing that regulators think about when you're kind of contemplating this different set of charters is really whether or not there's a level playing field. And so,
Okay.
I think if you went back a couple of years and there was like some discussion around the ILC charter and the use of the National Trust Charter, one of the things that we heard a lot was let's focus on the activities and not necessarily the label of the organization. And I think the whole intent of that was really to kind of focus on for this specific set of activities, there's a specific set of risks, and are we treating those risks and activities fairly across the entire financial services system? So I think those are kind of like the two things I think about is like, in some sense, it helps promote financial inclusion and innovation more broadly. But the flip side of that coin, though, is that, you really want to create a system of level that provides a level playing field for all financial institutions based upon the activities and risks of their specific business model.
Yeah. And something that I've thought about is that, thinking about the charter as technology, and then also a company would get this charter and then use modern technology. And so I was talking with Alex once about industrial loan charters and the difference between now and DDA accounts and how it just kind of doesn't matter anymore from like a consumer perspective. Like a consumer is just not going to really appreciate the difference between these two things. And that part of that is because one, it's a company election, but two, because technology made those differences not matter. Like whatever the difference is, it just doesn't really ever come into play because we have so much digital technology that really has flattened the differences between those two products. And so I've been thinking a little bit about how that the charter once awarded, the powers and privileges of it would be delivered via technology that this company might be more aggressive in or more skilled at relative to the technology that the legacy charter holders, legacy financial institutions have, that maybe that creates the competitive disadvantage, right?
Yeah, I think that's absolutely right? And that anytime you have new entrants to the market, they're going to have a different choice in tech stack available to them,
for sure.
Right? And I think we've known that the tech stack is a particular challenge for the incumbents. And so thinking about how that dynamic plays out and how traditional financial institutions can help close that gap to those that are new and entering the market. It's kind of funny, but I used to kind of joke with some friends a couple of years ago and say, if I were starting a financial institution today, I wouldn't go out and raise a bunch of capital. I wouldn't necessarily hire a chief credit officer. I think I would hire a couple of developers or engineers. I would probably hire a BSA or compliance officer. And then I'd look to find a financial institution to partner with and really kind of develop that front end or user experience and work from that point. And I think, I'm not suggesting that that's the best way to start a bank, but it is an alternative path that some
it's definitely
have
a different way to start a bank.
Yeah. And I think it speaks exactly to what you're saying in that, in a day and age where technology is so important, user experience is absolutely crucial. And it does kind of change the equation a little bit for new entries into the market. And I think those institutions that are in the market or have been in the market for a long time need to consider that and how it kind of really meshes with their strategic plan going forward.
Well, actually, since we're talking about legacy FIs, how concerned should banks be about applications, different charter applications that are coming in from these non-bank tech companies?
Yeah, I think. Sorry, give me 1 second here.
No worries.
We can edit this, right?
Yeah, we can just pick up the whatever your answer is, and I can also ask the question again if you need to.
Yeah, sorry, I lost track, and I know I had some specific thoughts here.
This is question number 6.
Question 6. Okay, so we already talked about competition, though, right?
Yeah, a little bit. I just was wondering how concerned should legacy banks be about these. Or did you not want to talk about that? We can just move on to question 7.
I don't think I deleted that one. Sorry.
You just decided you weren't going to answer it?
Yeah. I must have missed that one in my notes. Um, I know I responded to that one.
We did, we did kind of gesture towards competition in the last answer.
Yeah, okay. I've got it here. So
Okay.
Can you ask that question again?
Yeah, of course. So how concerned do you think, legacy banks should be about the types of applicants and applications we're seeing, especially the ones that come from like maybe the digital asset companies or other non-bank technology companies?
Yeah, I think this is a really good question. I think that financial institutions, incumbents, especially community banks, have been under pressure for a long time. When you think about the introduction of new technologies and innovation more broadly, I don't see these new entries that are specifically focused on digital asset activities being a particular or immediate threat to some of these institutions. And that I think a lot of these customers that these new entrants are hoping to capture are not likely the same customers that community banks are banking on a regular basis.
Sure.
So I don't think about the threat as being kind of immediate or over the short term, but certainly over the medium or long term, right? In that, with all of these new entrants, I think it really expands the permissible activities or expands that regulatory perimeter. It changes the landscape of banking in technology in terms of what's possible. And so I think for those institutions that are caught a little flat-footed, I think that they might find that there's certainly challenges over the medium or long term, but I don't know if it's something that challenges their customer base on day one. Yeah.
Yeah. No, that makes sense. And I was talking to someone about this today, and I was like, if you're worried about stable coins, like really worried, like maybe invest in payments, right? Like maybe think a little bit more about your payments. But I'm always like kind of amused when I see banks or their trade groups on one side saying, we want competition, we need more banks, and then be like, not those banks. No, don't let them in. And it's like, I don't know, man, that's a very specific type of policy that I don't think we're getting anymore from at least the administration or the agency heads. And that's just my opinion. I'm just looking around at some dynamics that I feel pretty confident about.
Yeah, I think this idea of competition is really interesting, though. And I mean, you bring up a good point of like, for those traditional financial institutions, should they welcome this competition? Should they be prepared to defend against it? I had some really brilliant colleagues at the Federal Reserve that wrote a paper a number of years ago that focused specifically on this topic and really more from the perspective of how does it adjust or have an impact on what we kind of refer to as the regulatory perimeter. Yeah. And so they talked a lot about kind of what activities take place outside of the regulatory perimeter and how that spurs reaction within inside the regulatory perimeter, or how that perimeter itself is permeable to a certain degree, and activities can kind of move inside or outside of that perimeter. And I think in the context of competition, that concept or that idea is really interesting in that we're now having these activities that were sort of outside of the regulatory perimeter. Now they're very clearly within that regulatory perimeter. And so now you're bringing new actors along with these new activities. I think for traditional financial institutions, certainly you should always be aware of any threat or potential competition. But I think maybe the benefit of what's taking place is that you have this set of activities that opens up what's possible from within the regulatory perimeter. And then going back to my earlier comment about creating a level playing field, I think many of these activities were taking place long before they were kind of brought within the regulatory perimeter. And now that something like the Genius Act really kind of puts them on somewhat of a level playing field in terms of federal supervision. And so, I think in many aspects, it does probably present that medium to long-term competition, but in the same sense, it really kind of opens up what's possible for them, and creates somewhat of a level playing field. I think the trick with all of it is just being prepared to adapt to what those activities might bring.
For sure. So while we're thinking about these applications, can you tell us like what it's like to kind of receive and evaluate the application and what regulators are looking for when they receive these applications? And I mean, this could go for even just traditional community banks. There's been very few that have opened in the last decade.
Yeah. Certainly. I think, going through an application process for anyone, whether you're on the regulatory side or seeking a charter, can be a really significant undertaking, right? And so, in my experience, I helped work through a lot of novel applications in my prior role. And I think the first thing we noticed when you would pick up some of these applications is the completeness or thoughtfulness of particular business models. I think in some instances you looked at it and said, well, okay, they've thought through a lot of the different risk impacts, how to plan for those, how to remediate. And in some instances, it seemed like maybe they wanted to preserve as much flexibility as possible, which I can certainly appreciate, but it does make it really difficult to kind of assess. And so I think that's the thing to keep in mind, is that really that applications process is the start of a supervisory relationship. And in some ways, going through that application process is like working through a mini exam. It's kind of your introduction to the examiners. And really regulators have this certain, I guess, incentive, if you will, to not necessarily onboard an entity that's going to be a supervisory problem down the road. So You're really trying to do thorough due diligence and work through all of the different statutory factors, but also think through like what supervision looks like for that particular entity. If I could boil it down to just a couple of things, and this is a thought from a really brilliant colleague of mine at Crowe. He kind of say that it really kind of comes down to two things, and that's capital and confidence, right? And whether you're a traditional applicant or one that's focused on novel activities, I think it's really about demonstrating whether or not you have the capital to support your business model, and then really whether or not you can kind of inspire confidence within the regulators that you can now operate as a highly regulated and supervised financial institution.
Yeah, and I feel like those are just rules for the road, right? Like capital confidence.
Exactly.
You don't want to don't start out with it and then not have it, but it's like have it all the time, right?
Yeah.
In banking, conditions change fast. Credit teams need to adapt without sacrificing credit quality, compliance, or control. That's why banks choose Tactile's AI decision platform. It gives teams the power to design, test, and refine credit, fraud, and compliance workflows using AI quickly and securely. With seamless data integrations and built-in testing, every decision flow can be optimized in real time. With Tactile, AI isn't a black box. It's transparent, explainable, and regulator ready, so banks are always prepared for what's next. For more information, visit tactile.com. So what kinds of things might a novel application encounter in its first few years that are similar or different to what we would say is a traditional de novo bank?
Yeah, a couple of thoughts come to mind here, right? And I think one of the first things I think about is what's different from the consumer standpoint, right?
Yeah.
And so if you're an entity that's seeking a charter and you're engaged in novel activities, I don't know if a whole lot changes for the consumer, right? Like from a consumer standpoint, like you can still open an account, you can still process payments. Those are all things that you've been able to do before.
Yeah.
And so I wonder about whether or not some of these institutions that are entering this space are going to have a really strong customer base on day one, right?
Okay.
And I think certainly some seem to be entering this space with specific market segments in mind. And so maybe that's kind of a path to scale or acceleration or growth. But I think there's going to still be this process of differentiation. And I think that's something that a lot of traditional financial institutions have to work through once they receive a de novo charter, right? Of like kind of building that credit portfolio, building that deposit base, reaching that scale, while at the same time building a lot of these compliance and risk management frameworks. And so, I think with some of these activities, even though they're rather novel and there might be a really significant need, I don't know if I see it as one institution kind of all of a sudden has the charter and now everyone's running to bank or partner with them. I don't know if I see that being the case. I think I more see it as kind of a gradual migration from some of these non-regulated entities to the regulated ones. And I think that will still be a challenge that many of these de novos have to work through, and kind of building scale, reaching profitability, and again, making sure that they're working towards those compliant and well-managed risk frameworks.
For sure. Yeah. I've been thinking about how the one National Trust crypto bank is like no longer a de novo, and how weird that is. That's like, we just don't have, and why being a de novo is so different than being a more established bank. And what is so, as someone who started her career after the financial crisis, to learn then what was so risky about the de novos, and why did like the class of the 4 to 7 year de novos kind of fail, and what did that mean about how the challenges of just being a startup bank, right?
Yeah.
And how that's like a little different than being like just a regular startup.
Totally. And I think, at least for some of these organizations that are seeking charters, I don't know if they get to like automatically skip past that part, right?
No.
Yeah.
They don't.
I think, I mean, it probably depends upon the business model, and maybe there are some that have really obvious synergies when they can kind of marry that with access to the payment system.
Right.
But if you're thinking about it forming a true financial institution in a de novo status, like, I think a lot of it is pretty similar to what traditional financial institutions go through.
Well, so we've spoken about charter applications, and that these would be going to a banking regulator, but you've mentioned the master accounts, and you've also alluded to the fact that payments activity is shaping so much of financial innovation. And I've been kind of fascinated by just like the laying out of the game plan on some of these National Trust charter applications that are like, we're going to get this, and then we're just going to also get separately a Fed master account, which famously not easy to get, or haven't been in the past. And then that's all we need. Those are the two things we need.
Sure.
We won't bother anyone anymore. No application for deposit insurance for the most part. So can we talk about why a company that's focused on maybe some more innovative areas of finance might be interested in pairing these two pieces of technology together, and how they might be used?
Yeah, I mean, I think first and foremost that if you're an entity that's kind of entering in the payment space, whether that's digital, fiat, and you don't have direct access to master accounts, then you're having to rely upon another financial institution to facilitate that. I think right off the top, then that really kind of cuts into the efficiency and profitability of the process, right? And so I almost kind of view that as like it's almost mandatory for many of these financial institutions to have that access. I think you kind of talked a little bit about some of the National Trust charters, and that's not a foregone conclusion with all of these.
For sure.
So in 2022, the Federal Reserve released an updated version of their master account access guidelines, right? And I think everybody's well aware. And I think since the release of those guidelines, there's only been one National Trust charter that's received access since then, right? And so it is a different process than kind of obtaining that application. And like I said, it's not necessarily a foregone conclusion. It's my understanding that some of these National Trust charters, even though it might be a significant part of their business model, they would kind of slot into what we kind of consider that tier 2 status. And so there are all of these considerations that they have to work through in obtaining that account access. So things like risk to the payment system, whether or not they can manage their daylight overdrafts or present any undue credit risk to the Federal Reserve. Financial stability is a factor. So if their business model were to have like broader applicability or really take off, does that threaten the financial stability of what we have within the U.S.? I think another big one is the ability to control for illicit activity through their payments activities. So having a well-founded and supported BSA AML program is going to be a really significant consideration for any of these institutions that really wants that master account access as part of their business plan. And then, something that's not often talked about, but really anything that could really hamper the transmission of monetary policy. So all of these things are kind of like reflective of the Federal Reserve's overall objectives and how they administer Federal Reserve account access. And so, like we've kind of talked about, we don't have a lot of examples here. These guidelines are only a couple of years old, and we haven't really seen them play out. So I, like many others, am probably a really fascinated observer in this space to see how this works, and how the Federal Reserve works through these issues going forward.
For sure. And we've been talking about kind of around this, but stablecoin often gets kind of thrown in with the digital assets crypto conversation. There seems to be kind of a friend-foe dynamic here with banks. Kind of reminds me of like fintech back in the day, like fintech friend-foe.
For sure.
And so banks are really wondering what to think about it. I've already shared that I think if you're worried about stablecoin, you should maybe look at your payments umbrella more. But Dan, what do you think?
Yeah, I think I spend about half my time talking about payment stable coins with our financial institution clients. And I think I've said a lot in the last couple of months on this space. So trying to boil it down to like, what are Dan's like 2 or 3 thoughts?
What are you saying all the time?
Yeah, I know, right? I think if I could kind of leave any impression, I think what I would kind of say is that I'm a true believer that banks have a role to play here. And I think this gets back to some of our earlier conversation around this idea of interoperability and how banks kind of sit at the nexus of the exchange between fiat and digital assets, right? Sure. And so if we think about where a majority of funds sit today, they're in bank accounts in fiat currencies, right? And so any type of transition or conversion to digital assets is going to be really reliant upon the banks to provide those on and off ramps. So I think they already play that role, and they'll continue to play that role for well into the future. Again, like I said, until we likely have some type of CBDC. But even more broadly, or maybe beyond that point, in that I view banks as kind of being a really important part of the process for managing financial stability and guarding against illicit activity. And so bringing some bit of that risk management and compliance institutional knowledge to the industry as well is a really critical role. And so I think for that reason, I think banks need to play a very vital role here when we're thinking about that interoperability between digital and fiat. Another thing I really think about is I used to say this on the regulatory side a lot, in that novel activities don't necessarily lead to novel risks.
Okay.
I think rather what we often see is that novel activities kind of lead to a different manifestation of familiar risks. And maybe that's like a really silly way of saying something that's basically the same thing. But I guess the point is that I think financial institutions are much more familiar with what it takes to engage with stable coins or digital asset activities than what they might realize. I think they're much more familiar in dealing with the risks. I think the key is understanding what's different about digital asset activities and how to tweak existing risk management or compliance processes to really adjust for that. And so the best example I really give is just having some bit of visibility into on-chain transactions to support the existing BSA AML process, right? And that's to say, like, BSA AML or money laundering or illicit finance is still a risk. And there's still those expectations that banks manage that risk, but just tweaking existing processes to make sure that it accounts for that digital asset activity is really the key. And I think more banks are better prepared to deal with that than what they might think.
Yeah, again, going back to the idea that the charter is a piece of technology and it would give you skills and competencies and give you a set of risks that need to be managed. And sometimes I always hope that banks understand that they have kind of the tools within themselves.
Yeah, definitely.
To do these things, but they are hard. That is to take away nothing about the work, but that there is sort of a logical extension, or there is a fundamental shared knowledge base that could be tapped into by curious and diligent bakers that truly wanted to be good at this. And that at a certain point, it's not really about the task itself. It's like, do you want to be doing this or not? Yeah,
I think so. And you make a good point, right? In that it's not always easy or clear.
Almost never, actually.
Never. It never is easy. You're right. But it is certainly possible, right? And I think that's the message I want to leave your audience with, in that it's certainly possible, and you shouldn't necessarily let that fear kind of lead to avoidance as opposed to engagement.
Yeah. So in our prep call, we kind of talked about this issue. Like you and I have been talking about very specific things like types of charters, review of the charters. But I think we are kind of gesturing at this like broader shift or evolution or change in banking or an expansion, right? You mentioned the supervisory perimeter and that is expanding arguably to include more things. So the umbrella is getting bigger.
Yeah.
So you know, it's impossible for me to look at these applications and not think that the types of companies that are involved in these services or these with you know in banking is going to change, and you called this a supervisory versus a policy decision. That we're now these are kind of policy decisions that help us think about the individual, right, supervisory actions we see. Can you help us explain that more? Or can you explain that more to me?
Yeah, I mean, I think the point is that like with every application that's being considered, you know, regulators are having to kind of make that supervisory decision and that's the baseline, right? And we kind of talked about that a little bit to where, you know, that initial filing of the application is the beginning of the supervisory process. And then, you know, whatever's reviewed or discussed through follow-up, that all kind of flows into the discovery exam and the beginning of that supervisory relationship. But there's also that policy element to some of these decisions. So there are all of these statutory factors and guidelines that help guide applications. But as we kind of mentioned earlier, with the clarification that digital asset activities are really allowed, you know, and there are specific charters that are targeting this activity.
Yeah.
And I think that really is a policy decision about kind of what crosses over to within the regulatory perimeter. And so it's not every instance to where every application triggers that policy decision, but certainly some of those are having to be made as we kind of expand that regulatory perimeter and really make room for innovation within the financial services space.
Yeah, I think about it as like, so I referee soccer and, you know, they call it calling balls and strikes, right? Like you can just like, you can make these like small decisions, but, and many referees when they first start out, that's the only type of game that they're capable of calling. But as you grow and as you grow up in the game and you referee more competitive games, you actually have to kind of have a vision of the game and you have to have an understanding of the team tactics and you have to have a read and you have to have an appreciation of how your decisions shape the game or how people will respond to you. And it's not such a policy decision, but like sometimes there are rules, like they'll be like, I don't know if you like soccer, but like the offside rule, the interpretation of it has changed. I would go ahead and say it's easier to be a new referee who doesn't have to know about the history of the offside rule and how it had been enforced than to be someone like me who's seen it changed a couple of times. But they changed that rule because they decided they wanted more goals in soccer. And so like the way that the officials enforce this offside or interpret offside now should potentially lead to, quote, more exciting soccer, more goals scored, right? We are now interpreting the rule in favor of the offense rather than the defense. And I think that that's like, it's hard to sometimes understand, like, when you're calling balls and strikes, you kind of miss the overall game. You're not seeing the overall game. And there is like a level of appreciation that goes into you know, the examiner role or the regulator role or the supervisor role shaping this construct that then other people have to respond to. And then if you change what you do, other things might change in response to that. Yeah,
absolutely. I think you're absolutely right. And I maybe to kind of like keep with this analogy of kind of calling those balls and strikes, I think it's a lot of it is about kind of being prepared for what's the next step or what's maybe the knock-on effects of that, right? And so, you know, when we think about like expanding that regulatory perimeter, especially in the case of novel activities, you know, I know I just said like novel activities don't necessarily lead to novel risks, but it does take time for everyone to kind of understand how risk management practices need to adjust for some of those novel activities. And so thinking through like how does supervision need to change? How do expectations need to change? How do examiners need to change, right?
Yeah.
I think it's all of those things are fundamental to kind of expanding that regulatory perimeter and making sure it's done in a safe and sound manner. And so it's kind of about, like you said, like taking a step back, thinking about some of those broader policy implications, but then also ensuring that supervision and bank risk management practices more specifically are ready to go, or like ready for that change.
Yeah.
Right?
Yeah. Well, my final question for you, to kind of summarize and put a bow on this whole conversation, is, there's been some speeches, some announcements from federal banking agencies over the last couple of weeks or months that hint at how the supervisory landscape might be changing. How should me and how should listeners think about these kind of tea leaves and hints and clues as we think about innovation in the banking space going forward?
Yeah, I think this is a great question to end on, because I think it's maybe it's an opportunity for me to like foreshadow what's going to happen over the coming years. And I'll caveat that with I'm terrible at predictions, so please take this with a grain of salt. But I think there have been a number of interesting announcements or speeches made by policymakers within federal banking agencies that have really suggested a shift in the supervisory environment, right? So
Yeah.
I know that Vice Chair of Supervision, Michelle Bowman, has talked a lot about refocusing on financial condition, as has other leaders within federal banking agencies. I think that's a really big one to pay attention to. I think getting away from some of those more process-oriented findings or areas of risk is really a pretty significant change over the last couple of years. I also think about some of the more recent announcements coming out of the OCC in the last couple of weeks. I think some of that stuff is fairly intuitive or maybe common sense. So, for example, like there was something on non-deposit investment products and risk focusing model risk management. I think that makes sense to me, right? And I think maybe to some degree, a lot of that was probably happening already. But some of the big stuff I think about is defining unsafe and unsound practices and really allowing that to kind of drive how examiners apply findings. We've been through similar types of situations in the past couple of years. And it certainly has an impact in terms of examiners in the field and the way they supervise and the way they communicate findings. And sometimes it's really necessary, right? Like I think there always is a need for both supervisor regulators and financial institutions to really kind of take a reset and think about their risk tolerance on a periodic basis. And so I think a lot of this is really important to do on a regular basis, but kind of understanding how it could play out and what may come of it and how your financial institution proceeds, I think is going to be like where the rubber really meets the road here. And so paying attention to like what comes from the federal banking agencies in the coming weeks and months, and really ensuring that kind of aligns with your organization's plans is that's what I'm most focused on over the next couple of months.
For sure. I think it is really interesting to see kind of the supervisors or the bank regulators be so explicit. Like they're just so plain spoken now. It just feels, like we're not reading between the lines anymore. But going back to my soccer analogy, sometimes the teams like the way the offside rule is applied to them, and sometimes the teams don't like the way the offside rule is applied to them. And you do kind of just got to keep up, and you got to be flexible, stay informed. But it's I also. And maybe this isn't like the best advice, but like, if you're a bank and you feel like you're on a winning path and you feel like you've got really good risk competencies or products or whatever, your customer base, like just focus on, I don't want to say just focus, but like that's like focus there, right? That's how you're going to win. And I think about, and hopefully the regulators stuff works in your favor, but just, I don't know, kind of stay focused on your knitting, right?
Yeah, no, I think that makes perfect sense, right? In that, we always talk about it with our clients in that, we're definitely in a different regulatory environment than we were a year or two ago. That's not to say this will always be the regulatory environment that we're in. And I don't know any bank that takes on an initiative and say, we're going to build this for the next 2 years, right? I mean, banks, have a much longer vision than just the next 2, 3, 4, 5 years, whatever it is. And so that's something we talk about is building for the long term and ensuring that whatever you're doing is done from a very defensible position. That said, though, it's a really great time to kind of take steps forward in the area of innovation. And think about how you just described it, like how can you focus on your customer base, what they need, and better delivering on that.
Right. Well, Dan, thanks so much for your time today. I hope we cross paths at Money 2020 somewhere in the Venetian. And I hope you have a great rest of your day.
Kiah, thanks so much for having me. Keep a lookout for my fashionable sneakers, and not my dad's sneakers.
Thank you for listening to this episode of Bank Nerd Corner. Stay up to date with news and trends in the bank space by subscribing wherever you get your podcasts. Also, if you love FinTech Takes Banking, please tell a friend. Talk to you next time.